All right, it is that time. Welcome everybody to the October 5th version of the Fats, Fuels, and Oils webinar. We're going to be talking about vegetable oils this week. Next week, Ryan might be traveling, so you might be stuck with me again next week. I'm not sure whether he's going to be traveling, going to the AFOA or not at this time on Tuesday. But I know I'm also going and my plane leaves later. So even if Ryan's not here next week, I will be here next week. All right, with that, let's get down to what is going on in the vegetable oil markets. So we've seen a pretty steady rally in soybean oil prices and vegetable oil prices more broadly over the past week. Obviously today that has picked up some steam. In part that's been driven by gains in energy, although if you look at the HOBO spread, it's not particularly low right now, but it's certainly lower than it has been. It kind of bounced off about $2 a gallon over the last week, and that combined with the EIA data that came out last week that showed kind of a recovery in soybean oil demand for renewable diesel production, I think has added to the strength in soybean oil. In addition, you've had palm oil, which futures have risen to fresh new all-time highs, contributing to the general bullish sentiment in world vegetable oil prices. And so all those things are kind of combining with what a week and a half ago, 2 weeks ago, were probably oversold conditions in soybean oil to generate this bounce. Going forward, the question is, will we kind of hold? I think the 60-cent level, as I've kind of said before, is sort of the important level, both from a psychological standpoint and I suppose also from a renewable diesel demand standpoint relative to energy prices, of course. But that seems to be, I think, kind of the key level. Whether we can hold that or not will depend in part on how early Brazilian planting goes. If early Brazilian planting goes well and the market expects a big Brazilian crop, which I think we'll get another expansion in Brazilian acres, and we probably will get better weather than we had last year in Brazil. That suggests that we could have a huge Brazilian crop that may weigh on soybean prices, which in theory could also weigh on soybean oil prices, although I think as kind of this bounce has shown, if you take oil share down below 45%, or I guess I'll say it this way, it's probably really difficult to get oil share to stay down below 45% for an extended period. So a fall in soybean prices might have more of an impact on soybean meal prices than it does really on soybean oil prices. And that's kind of what we've seen over the past week to 2 weeks, where oil share had fallen below 45%, but now has climbed back up and is around 47%-ish, or at least it was recently. So the impact of the Brazilian crop might be a bit muted, but nevertheless, it's something that is probably going to increase the downside risk here in the short term. Once we get past Brazilian planting, then I think that you have the continued expansion of renewable diesel capacity. And I think that that has the potential to take us to new highs early next year or early in Q2 next year. We really think that renewable diesel capacity starts to take off in the second quarter of next year and basically almost doubles by the end of the year, or a little bit more than doubles actually by the end of next year. And given the fact that at least it feels like we have gotten to the limit or close to the limit for fat and grease feedstock usage, Any expansion in capacity is obviously going to cause upward pressure on soybean oil demand and then soybean oil prices. Even if we haven't gotten to the limit of fat and grease usage, the expansion in capacity is necessarily going to raise soybean oil demand from where we are now. Now, this week we also got USDA's monthly fats and oils report, which gave us a glimpse into the supply and demand for August. And that came in and showed kind of a pretty significant decline in domestic use. You can see here from this chart, this is where we are in domestic use, the lowest that it's been in 3 years. That was really due to it, at least based on our assumptions for biodiesel demand, soybean oil usage, and biofuel production demand, a slowdown in non-biofuel usage. As a result, I think that USDA is probably going to need to raise their 2021 biofuel usage by 200 million pounds maybe in the next WASDE report, in October's WASDE report, and take at least that much out of non-biofuel demand. I think they probably raise by, we'll call it 200 million pounds for biofuel, and then take, I would say, it looks to me like a little bit more than that out of non-biofuel, let the rest fall down to ending stocks. And their ending stocks could end up a lot closer to 2 billion pounds than to where it is now. That could also end up causing a little bit of pressure on soybean oil prices, although I think that at this point in the marketing year, we're really just kind of filling in the last remaining unknowns in terms of data and supply and demand usage. And so really it'll be much more about what's going on in 21, 22, the Brazilian crop, and the demand from renewable diesel producers. So while a change in USDA supply and demand outlook could pressure prices a little bit, and maybe it will drive them back down below 60 cents in the immediate short term after the WASDE report, I wouldn't necessarily expect them to stay down there unless we get unless the Brazilian pressure is really intense, or the pressure from Brazilian planting is really intense, and soybean prices fall down to $10 or something like that. I think that's the outlier case, but I think that's kind of what it would take to really drive soybean oil prices kind of significantly lower from current levels. Outside of the non-biofuel usage, I think the other interesting thing in the fats and oils report was really just the level of stocks. They didn't come in particularly high or far from our expectations, but if you think back to earlier in the year, we kind of had this period penciled in as a time when we would really start to draw down stocks. And given the fact that crush has been generally slower than we expected earlier in the year, and I think than a lot of people expected earlier than in the year, the fact that soybean oil stocks are still above 2 billion pounds kind of reflects a lot on the weakness in soybean oil demand, particularly from biodiesel producers over the summer. What we estimate in terms of renewable diesel usage is that it's been strong, but you can see over the summer months, we kind of were not as strong as we might have otherwise expected. And then obviously we think that, again, starting in early 2021, 22, we should start to see that physical demand as the people that are putting up plants or expanding plants start to reach into the physical market to secure supplies for their eventual opening. And then as they open and ramp up production, we expect a dramatic rise in soybean oil use in domestic renewable diesel production. Now, our forecast right now in terms of soybean oil usage might be a little too optimistic, or too high is another way to say it. When we started to look at and update our quarterly outlook report, which we've talked about on this call before as sort of a 10-year forward look at feedstock demand and what we expect biofuel production to look like over the next 10 years. We changed the way that we looked at the different fuel categories or technologies, I guess. We had included a significant portion of the expansion in renewable diesel. We had penciled in sort of co-processing as a big driver of the growth in that demand. That really hasn't penciled out. And so we took that down, transferred a lot of that just to renewable diesel production. But the other thing that we did, the other change that we made is we incorporated harder and larger assumptions around sustainable aviation fuel. We didn't go quite as far as the Biden administration proposal to have 3 billion gallons of sustainable aviation fuel by 2030, but we're not really that far off. And to get to that level by that time, we're going to need to see some substantial growth in sustainable aviation fuel production. And so that's part of why you see this big ramp up in soybean oil usage, just because the addition of that really kind of overwhelms the fats and greases. And so then as we run out of those, everything else gets tossed into either soybean oil or canola oil. But the canola oil percentage for renewable diesel going forward is relatively small, even if we do get the approval by the EPA for a pathway for renewable diesel. We still think that it will be mostly confined to West Coast plants. So it's relatively small, and a lot of stuff gets just dumped into soybean oil. So we could be a little bit too high. And I think I've said before here that we think that if we're 4.5 billion pounds above where USDA is for 21-22, I think that although that's a fairly wide range, I think that the actual usage probably ends up somewhere between those two. If we get sort of all of the plants to open that we expect to open, I think it'll be a lot closer to our number than to USDA's number. If the hobo spread goes back up to $3 a gallon or something like that, we could see some delays like we saw this year with CBR, and that could leave us a little bit closer to USDA's number. Either way, it looks very difficult for stocks to continue at the 2 billion pound level in 21-22. And so then the question just becomes, how low do we draw stocks? Part of the answer to that lies in that split between renewable diesel or biofuel production and non-biofuel production. And we've talked a lot about that and how low non-biofuel might be able to go to accommodate the growth in renewable diesel production. And we've talked about the level of imports. Those are going to be really key assumptions going forward, and will have a lot to do with different analysts' opinions on exactly where stocks end up for 21-22. The one thing that I think everybody can agree on is that, again, we probably won't be anywhere close to 2 billion pounds. For canola oil, we also got the supply and demand data from the Fats and Oils report for canola oil. That came in pretty much as expected. but the one area that came in a little bit lower than we were expecting was stocks, and that implies that stocks could be a little bit tighter than we're expecting at the end of this year. We're down to 131 million pounds versus USDA's 183. 50 million pounds isn't a huge difference, but if you look at the split between crude and refined, crude stocks we're expecting to fall down to somewhere around, I think it's below 50 million pounds. And that's just a tiny fraction of where we used to be. We were at 250 million pounds when NAS started reporting when they started the fats and oils report in 2015. So just on a historical basis, that 50 million pound difference isn't that great, but we're at the very low end of the scale, and I think every pound is going to matter. We saw the beginning of the seasonal ramp up in canola crushing in Canada, with COPA reporting weekly volumes that were substantially above where they've been the last couple of weeks. Still not at the upper end of the historical range, and a little bit below where they were at this time last year. And again, we expect that that's probably going to continue. We also got COPA's monthly estimate of crushing for July, I think it was, and that came in well below where we were last year, but again, sort of relatively close to what we expected based on the weekly volumes. As a result, we didn't really make any changes to our Canadian canola crush forecast. We left it at 9.6 million tons. That's a little bit above where USDA is, and they are probably going to come down maybe a little bit more when they cut production to match Stats Canada's latest estimate of 12.7 million tons in the October WASDE. I think they'll probably have to cut both, or I think they probably will cut both crush and exports, but ultimately I think that crush will end up being a little bit higher than where they're at, but not quite as high as the record levels that we saw last year. For palm oil, we got cargo surveyor data for September, and that there's basically 3 cargo surveyor reports that come out. 2 of them showed a 40% increase in Malaysian palm oil exports, and the other one showed a 33% increase in Malaysian palm oil exports. That's part of what's driving the palm oil market higher right now, is this restocking that we've been anticipating for kind of months and months and months. How long that restocking lasts, part of it is probably stocking ahead of Golden Week, although it's getting a little late for that. But part of it is certainly India's attempts to rebuild stocks, vegetable oil stocks in their country, and that's something that we've talked a bit about, that is finally starting to occur. And that's going to keep, as far as we think, that's going to keep ending stocks for 2021 below that magic 2 million ton line that we kind of think of as the difference between bullish and bearish. In much in the same way of soybean oil, we're getting to the end of the palm oil marketing year, and so the attention is really going to be shifting focus to where we're going to be in 21-22. This week, the Ministry of Plantations and Commodities in Malaysia announced that 32,000 migrant workers were going to be allowed to come into the country to begin harvesting palm in mid-October. And so that should help with the production, and it may extend the seasonal increase that we see in production a little bit further than we typically see. Typically, production peaks in September or October, and then kind of falls through the winter and bottoms in February or March and then starts to build again. Because of the labor shortage, we may see a peak this year in November. Not entirely sure that that's the way that it'll play out. Maybe November is just a little bit below what we ultimately get in October. But I think production is going to be stronger. And I think that there's the potential for production to be above market expectations in 2021, 22, because of the return of the foreign workers. And so we've got production up to 19.5 million tons. I think you could pretty easily make a case for 20 million tons, or maybe even a little bit above 20 million tons in Malaysia. And if you get that much more production, that could really change the outlook for palm oil. If I add 500,000 tons to my Malaysian palm oil production forecast, don't change anything else, again, we're back above that 2.1 million ton number. Now, I think that for palm oil, I think with an increase in supply, you probably will also get an increase in demand, just because there's going to be a shortage of vegetable oil supplies again this year due to the drought in the northern plains of the US and the Canadian prairies. Those canola supplies that either aren't exported, or that the canola seed that's not exported and then crushed in countries like China is going to have to be made up with some kind of vegetable oil. It probably means that soybean oil exports out of Brazil are stronger again this year than they have been historically, because I don't see that soybean oil exports out of the US are going to be stronger. But because we expect US exports to remain really low and basically at the level that the lowest level sort of possible, Brazilian exports are already going to be in strong demand. And so the shortage from canola plus Brazil kind of backfilling US export demand leaves palm oil as a viable alternative for some importing countries. And so even if we do get this increase in production next year above where market expectations are right now, I would probably just add whatever I add to supply to exports and leave ending stocks unchanged, at least until we start to get some data around the pace of exports out of Malaysia for the first couple months of the marketing year at least. All right, switching over. Oh, our futures forecasts, we didn't really make any changes this week. That said, I'm probably going to have to bump the front end up. Probably the first couple of months here, we're already above the upper end of our forecast range as of today. So I'm probably going to have to bump this up a little bit. That'll really just make the slope of this line a little bit lower. I don't think we're quite at the point yet where we're going to start bumping up the whole line. But we may keep the shape of the forward forecast and just raise the whole thing eventually. But right now, given the uncertainty about the RFS mandates and Brazilian production, I don't think I'm quite ready yet to start to move up the prices for next summer. Similarly, canola, we didn't make any changes here, and palm oil also the same. Canola will probably rise with the increase in soybean oil, so that the spread between those two remains close to the historical norm. Although there's probably some upside risk in that spread just because of the shortfall in canola seed production in the U.S. and Canada. So if that spread does expand, then maybe these numbers go back above $1.25, which is where they were several weeks ago. For palm oil, again, I'm probably going to have to bump up the palm oil, the front end of the palm oil forecast, because we've already run above the upper end of my range. We do expect maybe a little bit of weakness as exports slow and production ramps up. But it will be tough for palm oil to fall too much relative to soybean oil. The spread between palm oil and soybean oil has just gotten back to sort of within its historical range, at least for the nearby contracts. The March contract is still out around 12 cents, but we saw last year that that spread theoretically can go back to above 25 cents. I don't think that that's necessarily going to be the case this year. And so if we do get some real strength in the second quarter of 2022 for soybean oil, I think that the middle part of our forecast could probably rise as well. Okay, now let's move on to biomass-based diesel. The EIA reported its renewable fuel production excluding ethanol last week, and it came in pretty close to what we were expecting and relatively close to, if you take the domestic biodiesel and renewable diesel production reported by the EPA under its EMTS program, or I guess system, it was relatively close to that as well. It was less than 1 million gallons off of that total, which is not always the case. But we saw a recovery in July, and you can see that we expect that August and September will remain relatively strong. The big question, I think, really is then what happens in the last quarter of 2021. On one side, you've got the improvement in the HOBO spread. So for at least part of September and October, profitability should have improved, although we'll talk about this in a second. RIN prices have offset a lot of that improvement in the HOBO spread. But I think probably the bigger question is the mandates and what some of the companies that are carrying deficits forward are going to do, and whether they're going to carry those deficits, continue to carry those deficits forward, or if the break-in RIN prices means that they're going to either buy fuel and blend it, or to offset the compliance deficits, or they're just going to buy RINs to offset the compliance deficits. I think that is going to have a big impact on what we see happen in production over the balance of the year. Typically, what you would see is kind of higher production in the last couple months of the year as people scrambled around to meet their mandates. But without a mandate to meet, I don't know that we are going to see that same activity that we've seen in previous years. You can see last year, December production was actually a bit below where it was for much of the year. And I think part of the reason for that is just this idea that one, RIN prices were relatively high, and two, without the mandates, there wasn't necessarily that same motivation to get RINs, to either generate RINs or buy RINs to meet the mandates. Looking at our profitability graph and forecast, we have both renewable diesel and biodiesel coming down. I talked a little bit about this in the commentary. I think part of the reason that we're seeing, and we also have obviously biodiesel sort of in line with renewable diesel, which historically has not been the case. Part of the reason that I think we see sort of the relative strength of biodiesel is if you look at our forward forecast for biodiesel prices, I think it's probably a little bit high, and it's kind of out of line with the trend that we've seen recently. We've seen biodiesel prices come down recently, despite the rally across the energy sector. And we've got a fairly large jump from the realized price last week to our forecast price from this week forward. And so I would say that biodiesel profitability could be even a little bit weaker than we're showing. Although if you look at the profitability with credits added, it still is negative. So I'm not sure there's a lot of room for that to move significantly lower. For renewable diesel, we kind of have the opposite situation where our renewable diesel forecast is generally in line with the prices that we've been seeing, but our fats and greases price forecasts are a little bit higher than what we've seen recently for fats and greases. And so I think that's bringing the profitability of renewable diesel down a little bit. With this move in soybean oil today, and with sort of a bounce off the lows and maybe a move back, sustained move back above 60 cents, we might see a turnaround in fats and greases prices. What we've seen so far is that the price movement in soybean oil translates into fats and grease prices, but with a lag. And so fat and grease prices peaked in September compared with June for soybean oil, and they've started to move just a little bit lower, but not that much, and certainly not as much as soybean oil. So if there's 3-month lag continues, then maybe you get some further weakness in fats and greases prices, and prices come in a little bit below where we're forecasting that they come in. But then maybe you get higher prices towards the end of the year, especially if soybean oil kind of continues to move higher. Again, you can see the price with credits. Like I said, the RIN prices, the decline in RIN prices has offset a lot of the work that the HOBO spread has done in terms of increasing the profitability for biofuel producers. We are expecting RIN prices to continue to move a little bit lower on the uncertainty, but then to start to bounce back once we finally get some numbers out of the administration. When that will be, we still don't know. There was a sort of a rumor going around that the EPA was going to release the numbers last Friday or the Friday before, and we still don't have numbers. And so in theory, it may be quite a while before we ultimately get those numbers, even though they have sort of taken the first step in the process of publishing the numbers and sent them to OMB. We do think that once we do get the numbers, based on what the administration has said they want to do so far, that it probably will solve the problem of the ethanol blend wall. And as a result, the spread between D4 and D6, we think probably gets relatively wide, certainly wider than we've seen over the past year. That concern about the ethanol blend wall is a big driver in the difference between the D4 and the D6 prices, because if we don't produce enough ethanol to meet the ethanol mandate, then we have to produce biodiesel or renewable diesel to fulfill that mandate. And so then the prices become very, very correlated and the spread becomes very, very compressed. But we expect that, again, probably any cuts that the administration makes will be on the ethanol side. I'm not sure that there's a lot of room for them to make changes to the overall mandate. And so I think they would have to offset any cuts on the ethanol side with increases on the advanced biofuel side, renewable diesel and biodiesel production, to keep the total relatively close. I think that about the only area that they can really reduce is the cellulosic mandate, or the D3 mandate. And that's only a couple 100 million gallons at this point. And so I think any cut to the overall is likely to be relatively small. Now, in theory, they can kind of do whatever they want. There's a law that sets out what they should do and how they do it. And so if they make a big cut to the overall mandate, they will certainly get sued. by the biofuel the biofuel groups and farm groups. And so they could do that, but under the law, they really are restricted in the amount that they can kind of change the overall mandate. They can use an exemption to change the cellulosic because cellulosic capacity hasn't kept up with the law. And that's what they've done in the past. But again, I suppose they could ultimately do whatever they wanted to do there. Okay, outside of RINs, LCFS credits, and they have continued to move lower. We do expect them to recover, but I think we've expected them to recover now for a little while, and they kind of keep moving down. To me, this is maybe more surprising than the movement in RIN prices, because while we've seen more renewable diesel production than CARB anticipated, I think overall they're probably still bigger deficits than CARB anticipated. And so I think it's tough to imagine that we have an excess of LCFS credits that's driving the price down, but nevertheless, the price continues to fall. Still, we expect it to recover. All right, with that, since I've already gone over time, I'll open it up for questions. And just to remind, you can enter your questions into the Q&A portion or under the chat portion, and we'll try and get them all answered. So we've got one, just to clarify that gross margin with credits margin data includes just RINs and blender's tax credit if applicable. Let me show you this. There's a breakdown of all of the credits and the credit values. So if you go here, there's a credit value breakdown for renewable diesel. So renewable diesel includes cap and trade, the LCFS credit price, the D4, and the blender's tax credit. And then biodiesel includes the LCFS credit price, the D4 RIN price, and the blender's tax credit, but it doesn't count for the California cap and trade. Again, these are what we're trying to model here are theoretical companies in the California region, or at the very least shipping into the California region. We look at costs based on either California quotes or we add in transportation from central Illinois or Chicago to California, so that we're trying to really kind of emulate what's going on in the California market. But to answer your question, it's LCFS credit, blender's tax credit, RINs, and then cap and trade where applicable. All right, do you think that EV penetration in California is causing higher LCFS generation than anticipated? Though the volume of gasoline gallon equivalents isn't that material yet, they seem to be generating an outside portion of the credits generation given zero CI score. I think that EV penetration has been, although in California, it's probably arguably higher than it is in a lot of places in the country. I think it's probably still a little bit lower than they anticipated when they made their projections. In addition, if you think of the LCFS credit market as all of California energy needs as opposed to just transportation fuels, then the credits generated or the deficits generated by electricity generation are vastly larger than the transportation fuels portion of the program. And so I don't know if, I can't imagine that they are generating a ton more credits in that area. Certainly, I would think that things like hydropower out there are probably substantially below where they typically are or where they were expected to be. And so I'm am and have been a little bit surprised by the weakness in LCFS credit prices. I would have thought that they would have turned around by now. But I think that you could say that EV penetration again has been stronger there than it has been in the rest of the country, and that may be contributing on the margin to the weakness in prices. But in general, I just don't know that it's enough to really weigh on LCFS credit values. I'll take a deeper look at that. Generally, with the LCFS credit stuff, I kind of glance at most of the other categories and just focus in on the stuff that I track, which is the biodiesel and renewable diesel production and credit generation and deficit generation. But I'll look more closely at the EV credit generation, and if I'm back next Tuesday, I'll talk a little bit more about that. And if not, I'll do it the next time I'm back, and hopefully that will clear it up for you and for me as well a little bit better, maybe. All right, I have already taken up 10 more minutes of your time than I'm supposed to. Thanks as always for joining and watching, and thank you very much for your questions. And I will either see you next week or in a couple of weeks. And if anybody is going to the AFOA, I'll be at the AFOA. Ryan will be at the AFOA. We're both going to present. So if you see me there, please step up and say hi. All right, everybody have a great week.